One of my 10 rules of successful real estate investing is rule number 6. It's to take a top-down approach. So you start with the markets, you work your way down to the submarket, the neighborhoods, and then the property. A lot of people kind of do that backwards. They're looking at this property over here and that property over there. And, sometimes it's from one market to another. And you're just kind of scattered and you're not really starting where you need to start, which is bigger picture, and that is the market.
Welcome to the Real Estate and Financial Independence Podcast. I'm your host, Chad Carson. You can also call me Coach, and this is a show all about helping you get out of the financial grind so you can do more of what matters. Whether you're a long-time listener or a first-time listener, thank you for being back for another episode. The title of today's episode is Passive Investing in Real Estate, a deep dive with Marco Santarelli. Marco is the CEO and founder of Norada Real Estate. And the reason I wanted to have Marco on this show, he is an expert and has gone really deep in his own experience as an investor and also through his business, Norada, of understanding the perspective of passive investors. And what I mean by that, I know a lot of you work a full-time job, you're busy professionals, and maybe either if you're a new investor, you're kind of on the fence of whether you can make this real estate thing work given your time, or maybe you're already investing in real estate and you're just wondering, what's the big picture strategy here? How am I going to make this work so that I can actually live off my investments? And that is a conversation Marco and I got into. We're both nerds on the big picture strategy of real estate investing. I wrote the book, Retire Early with Real Estate, and a lot of his focus of his company is helping people get to that point where they have financial independence with their passive income. And so we talk about topics, kind of starting big picture, like why even invest in real estate instead of just putting your money in other assets like index funds or things like that. We kind of make the case, again, just the foundational case of why investing in real estate and directly owning real estate is a good idea. Particularly, we talked about today's economy, inflation, why it's even more of a good play to do. And then we get into some of the specific markets. And that's something where I really picked his brain a lot of what does it mean to have a good real estate investing market? And then how is the strategy for you as a passive real estate investor to turn this money that you've worked hard to save into something that can grow and then eventually into something you can live off of? So that is the conversation we talk about. We get into a lot of depth there. Also talk about Marco's story, starting when he was 18 years old, buying his first property, and he's been doing it for many years. And so I think you're really going to enjoy this conversation if you are wanting to be a passive investor, you're already a passive investor, and you want the perspective of someone like Marco who has done this himself and has helped a lot of other people do it as well. Now, as always, before we get to the interview, it's time for my weekly behind the scenes segment where I share a short snippet of what's going on with me in my real estate investing, my finances, or my business behind the scenes. And this week, when this episode is publishing, is in early August. And for me in a college town, the thing on my mind this time of year is turnover. So the apartments we have, the houses we have, often in a college town turnover right in the beginning of August. And it's actually a very busy time for my property managers. And when I was doing it myself, it was a busy time for me because you have about a 14-day window there, sometimes a 10-day window when you leave it vacant between the old tenant and the new tenant who's coming in. And you've got to get it painted, cleaned, any kind of maintenance things done. And you're doing a bunch of properties at one time, which is kind of interesting because you're using up all the contractors. So you often bring in handymen and contractors from all over. But my tip today, that's just to tell you what is on my mind this time of year. But my tip for you is when you have a turnover with your own rental property is a very simple recommendation. I am big on checklist. There was a book written a while back called The Checklist Manifesto, which made the case for using checklists in everything. And I was already a checklist person, but it made the case for me that if you think about a pilot who's taking off on an airplane, they might have been flying thousands of times. They still use a checklist to make sure everything's working. A doctor who's doing a surgery on an arm does the same thing. And so you as a real estate investor should have checklists for everything. You should build what's called an operations manual. Even if you are outsourcing some things, you should make sure your property manager has a checklist. So my property managers do, when they turn over, have checklists. And when I was managing my own turnovers, I typically had 3 checklists at the time the property turned over. There was a handyman checklist, there was a painting checklist, and there was a cleaning checklist. And there's a 4th one whenever we had just a tenant checklist, like making sure we got security deposits, make sure we got keys, we got an inspection, walkthrough, things like that. But the point for you is having a checklist, like turning the process that you have of turning the property over into a process that you write down. And now, even if you have it in your head, and I know a lot of people say that, oh, I know what I'm doing. I have it in my head. I've been doing it for years. We'll put it on a list so that if you were not doing it, if you were handing this off to somebody else, if you had a spouse or a son or a daughter or somebody's helping you, or if you hired a property manager, you could have a conversation with them and say, here's my expectations. When it turns over, I want the handyman to check all the light fixtures, make sure there's light bulbs. I want to make sure they check for leaks in all the different plumbing places. I want them to look in the crawl space and check this. I want them to check smoke detectors. All those little mundane things are important, but then they can also check bigger things. Are there any preventative maintenance items we need to do? Are there things that just make it a better place to live? From a cleaning standpoint in particular, sometimes you have to be very specific. Clean this place, clean this, make sure you wipe down these baseboards. So it could be super mundane, but that's the point, is if you don't want to miss details, you've got to have a checklist. So that's my recommendation. It's something I've really built on over the years in everything I'm doing, from these podcast episodes to real estate investing. Have a checklist, and definitely have one for your turnovers. That's my behind the scenes tip of the week. If you like these behind the scenes segments, I want to invite you to stay in touch with me beyond the podcast by checking out one of my online courses that I offer. Online courses are a way to interact with me and let me help you with your real estate investing. Some courses are available anytime, and others, like my premier course, Real Estate Deal School, is more of a boot camp style course where you and other students go through live with me as I help you step by step to purchase your next investment property. You can get details on these courses at coachcarson.com/courses. Now let's get started with today's interview with Marco Santarelli. Hey, Marco, welcome to the podcast.
Chad, it's an honor to be on here. I've been looking forward to this for weeks now. So thank you.
Yeah, thank you. Me as well. And I'd really love for this to be, I've been kind of thinking as I researched this conversation, to have a deep dive on passive real estate investing. And I think this is you have many expertises in the real estate realm, but just really the idea of being a passive real estate investor yourself. You've done it yourself, which I want to talk about a little bit. And you've also helped a lot of people do it. Busy professionals, people who have jobs, they're doing other things, and how do you invest in real estate? So I would love to take a deep dive on that. And it would be good just to start, just so people know a little bit more about you. I thought I started early in real estate investing at 23 years old. You started at 18 years old. So maybe you could just give us a little bit of a kind of a starter on how did you even get into this real estate thing?
Yeah, it's true. I cut my teeth at the age of 18. The only reason I waited until 18 is, as funny as that sounds, is I couldn't qualify for mortgage financing prior to being an adult. So otherwise I probably would have started at 16. How did I get started? You know what? I just knew at a young age, probably at the age of 9, that I wanted to be, I didn't know what it was at the time. I call it financial freedom now and time freedom. But at the time I wanted to be quote unquote rich. But I was a kid, right? But I just knew that was the direction I wanted to go. And I didn't want to have a job. Both my parents worked. My mother actually worked 2 jobs simultaneously to make ends meet. So I didn't grow up in a well-to-do or a wealthy family, but I noticed people that my parents knew were financially free. And I asked the question, why are they free? Well, my mother would point to this guy and she would say, well, he owns like 4 duplexes on Center Street in the town I grew up on. And it was very clear to me that real estate was a way to generate not only some wealth, but that time freedom through the income that it generates. So I set out on a path to study money. And I studied everything I could. I bought books. Well, I couldn't drive. I had to get my parents to drive me to pick up books and order stuff for me. But I read everything I could about business and entrepreneurship and investing. And I knew that real estate was the key. So I just set myself on a path early on at about age 15, 16 to learn what I could and then pull the trigger eventually.
Love it. Yeah, it's so interesting to hear the different motivations, and also there's different timetables people get interested. I feel like you're sort of like the racehorse of real estate investing. You just had this, and you're just super interested early on, and other people stumble in it later in life. But you had this kind of pull, this tug to build wealth. And I know when I first started investing, I had some like crazy like number goals. Like I want to have $1 million a year in income, and I didn't really know. It was more just the vague pull of like doing something big. And then, but over time it's become more specific, as you know, is like, lifestyle, time freedom, doing what matters. But, just getting you in that direction is a positive thing. You can adjust and you can learn. And by the time you were 18, can you talk just about that, that first deal? What got you into it when you finally were able to put some of your knowledge into practice?
You reminded me of something I wanted to say, a number of times, and I'm going to say it because it'll be recorded and on record. Someone who's not reading your blog post articles is sorely missing out. Like your articles are some of the best I've seen out there on any forum. or any website. So people need to read your stuff, subscribe to your stuff and read it because it is fantastic. I mean, it is spot on good stuff.
Thank you so much.
Yeah, definitely. So the reason I bring that up is because it got me thinking about some of the stuff I was trying to find way back in the day. But to your question, my first deal was an end unit townhome. I found this property that was reasonably priced. It needed a little bit of work. It wasn't distressed, but it definitely needed some cosmetic work, everything from carpet to paint and some fixtures. So I bought this property, minimal down. I was able to get financing because I worked at a grocery store at the time, and I made enough income from the grocery store that the credit union at the grocery store was able to, after working there for years, provide me mortgage financing. So I put the minimum down. I bought the property, got the financing on it, brought my uncle in, who was the carpenter and contractor. So I hired him to come in and do the carpentry and paint and whatnot. But I worked alongside with him, fixed it up, put a sign on the lawn. There was no internet back then. It was newspaper and signage. So I put the sign out, took applications, leased it. The interviews I did were hilarious because I had no idea what I was doing. I was just winging it. But ultimately I placed the tenant in there and had it leased for a number of years. Now, I will admit this was my first mistake and the first takeaway that maybe your audience can take from this interview. The biggest mistake I did in my life, and especially back then, is I sold that property a number of years later after I owned it. Yes, I had a fair amount of equity in it because the market was, healthy. But I was thinking very short term, not long term. I sold the property. I made a nice profit. Sure, I ultimately paid taxes on it, capital gains taxes. But in hindsight, looking at what I could have had today and the income that property would have been generating, and it would have been free and clear, is a huge lesson, at least for me, to never sell real estate. And if you ever do, it's only for a tax-deferred exchange because you're moving to another market or you're leveraging up. But you never sell your real estate because that property would have been, I think I bought it for $40,000 at the time. And I mean, that was a good price at the time. It's probably worth $400,000 now, and it would have been free and clear, and it would have been generating probably $3,000 a month.
And this is in Southern California where you live, is that right?
No, this was in Calgary, Canada, where I was born.
Oh, right. Okay. Got it. Okay. Yeah. Got it. So,
but real estate works just the same in Canada as it does in the U.S. There's very, very little difference.
Yeah. So interesting that, so you got started, you were working in a grocery store, you figured out the financing just the way you could, you got family members to help out, and you just figured it out on that first deal. And I think if I understand your story right, you were really interested in real estate as a professional, kind of like I was. You got into the business of investing or of being in real estate, got your license. I don't want to gloss over any of those details, but just fast forward a little bit. You talked about the tension of like selling a property, needing cash. I feel like my entire career of real estate investing has always been that tension of, I got to put food on the table, I got to make cash flow, and I've got to build this long-term wealth. And if you can hold long run, I agree 100%. Real estate is an incredible long-term wealth generator. You see these wealthy families from, hundreds and hundreds of years of owning properties have done really well. When was a transition for you to start getting into what now is one of your expertises, is owning properties long distance, where you're passively investing in them and your transition from the active real estate professional who's doing that as a business? Yeah,
well, the transition point was 2003. And you might remember back in 2008, or probably a lot of people listening to this remember back in the early 2000s, real estate was really strong. Like the turning point was around 1998, 1999, when real estate really started to catch on, not so much as an investment, but just the demand was pushing prices up across the country, and real estate was just a strong place to park your capital. But in 2003, real estate markets, plural, all around the country were hot. And so everybody was jumping into real estate, around 2002, 2003. So long story short, I got this email. I have no idea how I got on this list, but in the middle of 2003, I got an email from Robert G. Allen, who you probably know is one of the godfathers of nothing down real estate. He's authored about 20 books. In fact, he's a good friend of mine now. But I got this email from his organization called the Enlightened Millionaire Institute, which was later rebranded to Enlightened Wealth Institute. But they were putting on this free seminar here in Orange County, California, late that summer. And they were inviting people to come and learn about real estate. And it was, I think, a 3-day event. So I had time on my hands at the time. I was sitting okay. But I went to this event and I was blown away. There was over 2,000 people in this ballroom at a major conference center near Anaheim. And the presenter there was incredible. Like, he had you riveted to your seat. If you had to go to the bathroom, you wouldn't go because the information and content was so good and it was just flowing and flowing and flowing. But everybody was interested in real estate, and more so going to this event. But at the back of the room, they were selling these boot camps, right? So from $15,000 all the way up to $35,000, you can attend these 5 or 6 different boot camps in different cities around the country. And they were all very interesting. Everything from wholesaling to lease options to apartments to whatever. So I thought, okay, well, I've got time and I'm interested in real estate and I do want to do real estate full time. So that was the decision point where I decided to go from essentially being unemployed at the time. I didn't have to be unemployed, but I just chose to be unemployed for a couple of years because I didn't want to go back into corporate America, to becoming a full-time real estate investor. So I started going on these boot camps. And I was meeting literally hundreds of investors in these different cities that were going to these boot camps as well. And 2 things happened while I was doing this. And this was the whole turning point for me, going from a part-time investor / entrepreneur to full-time real estate investor and entrepreneur. Number one, I started buying a lot of property in a very, very quick manner. In fact, from 3,000 miles away in Southern California, I was purchasing in Florida, Georgia, and Michigan, and I purchased 84 doors in 9 months. So that's a pretty large acquisition. Yes. Over that period of time. Some of it was creative financing. A lot of it was the loose credit of the time where you could literally fog a mirror and get mortgage financing. So I was able to get financing for a lot of these properties. So I acquired a lot of property from 3,000 miles away. In the process of doing that, I was creating these systems and processes to be able to purchase and do due diligence sight unseen from far away. But at the same time, investors were coming to me at all these events and saying, hey, I see what you're doing. Could you help me, coach me, mentor me? And my answer was always, well, that's flattering, but no, I can't, because I honestly don't have the time. But I see a lot of deal flow and I'm not buying everything I'm looking at. So if you like, I can just pass those along. That was the light bulb moment. So that was the time when I went full-time real estate, and I recognized there's an opportunity here to build a business around this niche where people are paying money and spending time to educate themselves, but not being able to find the deals or have the time to find the deals or not know how to find the deals. And so that's where my company, Norada Real Estate Investments, was born, because I was in the space investing and people were asking me for help and I had the deal flow. And so I just turned it into a business, and I implemented my systems from long distance to be part of that service that we provide. Yeah,
84 properties in a year is amazing. You got to have systems, or 9 months, not even a year. I remember probably at my peak, 2007. I remember being my busiest year. Great timing, genius on my part, right before the Great Recession. I think we bought 33. We had 33 closings, and some of those are multi-units. So we had like 50 something units, and I felt like, wow, this is my business partner was smarter than I was. All right, we just need to take a break here. Let's take a deep breath. Kind of like after Thanksgiving meal, you're just trying to absorb your meal and sit there on the couch. But
right.
So for you at that point, Marco, so you really accelerated. You figured out systems, which I want to go into. I want to talk about your systems for analyzing markets. I just feel like that's one of your things that you do that's very unique, is looking at, agnostic on which market it is, what type of property it is, just looking at the fundamentals. What was your goal at that point? Were you shooting for, hey, I just want to build a bunch of cash flow so that I can then live off the cash flow? Was it, I want to build wealth 10 years from now? Did you even, not everybody has a specific direction, but I'm just wondering what was going through your mind kind of at that point when you decided to go buy those properties?
My strategy at the time was, I didn't have a strategy. I literally was ready, fire, aim. And I made a lot of mistakes. I lost a lot of money. I was in some lawsuits. I mean, all kinds of things were happening because I didn't have clarity, and there's a thing, you don't know what you don't know. And often because you fall on your face and step on landmines, you figure out what you shouldn't have done. And I've made many of those mistakes, and I don't want other people to repeat those mistakes. So, I was just buying some properties in really sketchy areas and poor quality neighborhoods, what I'll call, lower C and even maybe D class neighborhoods. Some areas were not appreciating, but depreciating. Some areas were appreciating hard. other markets. And so I was really learning a lot as I was going. I was figuring it out as I went. So yes, I was drinking from a fire hydrant, learning stuff from educators and, instructors and other real estate investors. But at the same time, I was really learning as I went. I have a saying, actually, it's a question. I ask this when I do, keynote speeches and presentations. I ask people, I say, finish the sentence. Ignorance is blank, right? And what do you think most people say?
Bliss.
Absolutely. And then I say, well, yeah, that's possibly true at times, but the reality is ignorance is expensive. What you don't know is costing you money, both in terms of opportunity cost as well as not maximizing what you are doing in terms of gains and leverage and whatnot. So without knowledge, you can't become a good investor. And without continued knowledge, you can't go from good to great. You can't be a great investor. So I was starting off pretty much green, back then, and I had to learn and waddle my way through the wilderness. So, but I ultimately figured it out. And then I learned what I should have done and what I should be doing. And I continued down the road of doing what I need to do. Yeah. But I learned what markets are good and what markets are bad, what areas are good, what areas are bad, what you should be investing in, what due diligence you should do. And it got to the point where I could do all of it remotely. I didn't even have to be boots on the ground. I just have to have boots on the ground, to serve me.
One of the things I love about this, your podcast, my podcast, the fact that people can listen to this and borrow those expensive mistakes that you and I made without having to do them themselves. I mean, what an education. I even think about 20 years ago when we were both starting. It was, we went to seminars, you read books, but to have a podcast where you can listen to the big picture and say, here's what Marco did, here's some things he did well, here's his lessons. In that spirit, let's take the perspective of somebody now who is often one of your clients. They're a busy professional. They know they like real estate, or maybe they're on the fence about real estate. Let's even start there. But they know they want to do something. They have that motivation like both of us had in the beginning. I want to take the assumption that maybe somebody's still considering real estate or not. And I was thinking about, the big picture idea of building wealth. You got the small nest egg. You're trying to grow it bigger. You and I are both kind of preaching to the choir when we talk about real estate, but why would you say this like big picture people should be focusing on investing in real estate versus investing in some of the other assets that they could be putting all their money in the stock market? They could be putting a mix of things here and there. Like, do you have a thought about asset allocation, particularly for people who are kind of young in their wealth building? Why should they even spend all this time focusing on buying real estate in the first place?
Well, me personally, I only invest in about three main things right now. And it is not the stock market, it is not the equities market, at least not equities publicly traded. For me, my investments are businesses. I invest in a lot of different types of businesses, but these are private companies, and I have an equity position, and I understand that. There's a lot to be said about business, because the beautiful thing about businesses is they don't have a ceiling. There's lots of upside potential, and there's virtually no cap. So one of the greatest investments you can make are businesses, but it takes expertise, takes the right team, it takes time. There's a high failure rate. So therefore you could argue that there's a high level of risk. So it's not for everybody. And those opportunities are not in front of everybody's face. So not everybody has the opportunity to invest in businesses that have high upside potential. Number two, definitely real estate, which is what I'll address here in a second to answer your question. And then the third thing, again, I say third thing that I invest in are some crypto assets, which is beyond the scope of this conversation. But again, that has to be a smaller percentage of a portfolio. It has volatility. There's a lot of unknowns. There's regulatory risk. There's all kinds of things going on there. So let's go back to real estate. Why real estate? I am super bullish on real estate, and I believe it is the one of, if not the best investments you can be making, because number one, it's a hard asset. You want a hard asset, especially today, especially over the last couple of years where we're in this super high inflationary environment. You need things that are strong inflation hedges. Number two, real estate is the most historically proven asset class. It's been around for decades and centuries. You know what it is, you know what it does, you know how it performs over time. You can't argue with it. There's history, lots of history and precedents to show and prove what it can and can't do. Thirdly, we all need housing. We need a roof over our head. That's not going away. And especially today where we have very strong demand for housing and a lack of supply relative to that demand. Fourth, with real estate, you have an asset that you can literally keep forever and then pass it on to your heirs that generates income. So you've got an asset that you can keep forever. You never need to sell it. It will continually provide utility to people, which is housing. It generates income, has tax benefits. It's leverageable. You can use your capital to invest in it and leverage it up to 5-1. And think about that for a moment. You could have 100% of the benefits of a piece of real estate, 100%, but only put 20% down and still control 100% of it, own 100% of it, have 100% of the benefits, and do that time and time and time again, rinse and repeat.
I was just going to add, and have debt that's relatively low risk on the scale of debt. When there's all sorts of leverage, and having a 30-year mortgage with a fixed interest rate is pretty incredible.
Well, that is very true, very, very true, but not to sound like I'm going to one-up you on that, Chad.
Go for it. Let's do it. I like it.
I'm going to one-up you on that. So not only you get a 30-year fixed rate mortgage on real estate, but think about this, that interest rate is fixed, that mortgage payment, that monthly mortgage payment is fixed. It does not adjust for inflation. What does that mean? That means that as the years go by, the value of that mortgage is diminished by the real rate of inflation, which means that the value of that loan becomes less every year. It becomes worth less and less each and every year. So essentially, inflation is your friend. Inflation is destroying the value of that mortgage loan every single year. So that $500 mortgage payment or whatever it is you have today, might sound like a lot, or maybe it's a reasonable chunk compared to the financial performance of that property. But think about it in 5 years or 10 years or even 15, 20 years from now, when you look back, that $500 mortgage payment is going to be like a Starbucks coffee at that point in time. So you got to put it into perspective that you're actually getting a rate of return off of that mortgage each and every month and each and every year, because inflation is reducing the value of that mortgage. And on top of that, your mortgage is being amortized, which I should have flipped around. I should have said your mortgage is being amortized every single month and every single year.
Yeah, I love that deep dive on debt, on the long-term perspective of real estate, and there's so many benefits, and that's a pretty good pitch for real estate. And I want to take that a step further. And this is something I'm very interested in. But if they look at real estate and okay, I'm in. I want to do this. It seems sometimes it's overwhelming to figure out the strategy that I'm going to actually use. There's directly buying in real estate, and even within directly buying in real estate, I could be a DIY investor. I could buy through other people, kind of doing more turnkey type investment. I could buy residential versus commercial. I could buy syndications. I could buy real estate investment trust. There's just a bunch of options out there to look at. And so I want to just get your perspective. You've helped thousands of people at this point, maybe more than that, to buy and put together a strategy, do consultations. What is the general, if I'm somebody who, let's say I'm 35 years old, I've got 50 or 100 grand saved up, like what's just the basic strategy for me 10 years from now? I'm going to wake up. Am I buying those properties, getting debt on them, and then I'm going to build a certain amount of wealth 10 years from now? Like I'm just, if you could kind of help people understand, like what's the actual game plan here that somebody could use those benefits you're just talking about to actually achieve something tangible, which would be financial independence, having some wealth that they could use?
Well, that's a big question. And you kind of gave so many different angles to it. The thing is I want to remember your question. You're talking about someone who's got 50 or 100 grand of investable capital to invest. What should, would their path or strategy be? I was going to start with the step before that. It's important for somebody to understand, what it is they're trying to achieve, because I've always said there's 101 ways to make money with real estate. And that could be from wholesaling to fixing and flipping to, long-term buy and hold to short-term rentals to whatever it may be. You need to understand what it is your strategy is, what your goal is to come up with a strategy. It's the whole, begin with the end in mind. What is the end for you? If it's to create wealth over a medium to long-term period and generate passive income for you and your family down the road, well, there's really only one way, in my opinion, and that's to hold a portfolio of property, regardless of what that is, but income producing real estate that will generate income for you short-term, long-term, and build equity, which is your wealth, your net worth over time. And that's a very simple formula. It's tried and true. It's very simple to understand, and it's relatively simple to execute on. But what people have to understand is it takes time. If you're not that guy that has that $50,000 or $100,000 today to invest, then you got to start thinking in terms of what I call chunks of cash. Because what our goal is to create is streams of cash, which we call cash flow. So if you want streams of cash, you have to start off with chunks of cash. Do whatever you need to do to create that 50,000, 100,000, 20,000 through your job, maybe 2 jobs, maybe a side hustle, maybe it's to scale your business if you're an entrepreneur and business owner. I don't care what it is, but maybe get your spouse to work. But you need to create those chunks of cash that you can deploy into income producing assets, 1, 2 at a time, to create those streams of cash. And then what you will find is over the years, those properties, as you start to stack them, will grow in value, will increase in equity. Rents will go up. They have to over time because we are in an inflationary environment. And even if we weren't, even if it was kind of flat, what we find is long-term, property values and property rents do go up. Especially in an environment where there's demand that is exceeding supply, that we have seen for, several decades now, actually since the early 1999. So that person that's got $50,000 or $100,000, they need to decide what market should I be in to meet my investment goals, and then what neighborhoods should I be looking at, and then deploy that capital into as many properties as you can that are in good neighborhoods, safe, clean, and functional, generating positive cash flow, and ideally in a market that has strong fundamentals, so you will over time see price appreciation. So that's a long and a short answer to the same question.
Yeah, I did give you multiple questions, and you did very admirably of boiling that down and simplifying it, which I love. It's so, first and foremost, somebody has to build capital. They got to save the money, and I know you talk about this, and I talk about it a lot too. If you're early on in your career, you got to get started somehow. That's why I love house hacking. That's why I love live-in flips, where you live in a house and flip it. I mean, if you generate that chunk of cash, whether it's 20, 50, 100 grand, now you're kind of putting yourself to another stage. And it is a pretty simple formula. It's just one of my mentors, John Schaub, it's just buy one house at a time, get it stable, get it rented. But there's some tactics there. And you said them very nicely and very succinctly, but I want to dig into a few of those. You said buying in a good location that has demand. And this is something that I've been really impressed with on your website at Norada, is just the way you evaluate marketplaces and kind of combine the metrics and then the big picture trends. And so I was hoping you could talk a little bit about what makes a good investment market for you. Like what are the qualities that when you see these, a list of whether it's metrics or whether it's just big picture trends, what are the things to say, that's a place where I would love to hold for the next 10 years or 15 years or whatever your timetable is in a particular market?
Yeah, for sure. Real quick, it's funny you mentioned John Schaub because I'm interviewing him tomorrow afternoon.
Tell John I said hello.
I will. Small world. That's funny. Big picture, the fundamentals are really boiled down to 2 core things in any particular market. And one of my 10 rules of successful real estate investing is rule number 6. It's to take a top-down approach. So you start with the markets, you work your way down to the sub-market, the neighborhoods, and then the property. A lot of people kind of do that backwards. They're looking at this property over here and that property over there. And, sometimes it's from one market to another. And you're just kind of scattered, and you're not really starting where you need to start, which is bigger picture, and that is the market. So when we talk about markets, we're looking at fundamentals. There's 2 core fundamentals that keep a market strong and healthy and growing in more than one way. One, it has to do with jobs. Markets, people live in markets and move to markets because they have job opportunities. Often it's for some people, it's just to get a job, for an income. But for other people, it's because they're moving up. They're always looking to advance their career. They're looking for more income. So they're going to potentially move, whether it's with the same company or another company, to another market because there are better opportunities for them in their career and for their income. So jobs and job growth are at the heart of any good market. Any market that you see growing and appreciating is going to have a very healthy job market. You want stability, but ideally you want job growth. That's number 1. Tied to number 1 is number 2, and that is population growth. There's a high correlation between jobs that have job growth and population growth. So when you see positive net migration, what it means is you've got people flowing in and organic growth within that population that's increasing the pool of people who need to buy and rent property. When you have the upward pressure on demand, it's going to naturally keep the housing market strong and healthy. And in most cases, you will see prices go up in terms of property values and in terms of rents. So that's a good thing if you're on the right side of the equation, meaning that you are an investor in that market. You own property or you're buying property. So you want jobs, job growth, and ideally positive net migration, population growth, because when that demand increases, you have to provide new households for those household formations. And therefore, the supply will try to keep up with that demand. And if it doesn't, you will see property values go up quickly. So those are the key things I look for. The third thing, if I was to throw a third thing in the mix, is a diverse economy. What I mean by that is that you've got jobs across multiple or many industries. It's not just oil and gas, as an example. You've got hospitality, finance, construction, housing, whatever it may be, service sector. The more diverse that economic base is, the more resilient that market tends to be in terms of market fluctuations, recessions, interest rate hikes, and whatnot. Because there's just a lot. It's just a more fluid market. People can move around much more easily, and it also attracts people from the outside coming in because there's those types of jobs there.
I think that's a great explanation, that you're looking for that economic kind of tailwind. You're looking for jobs, you're looking for economy, diversification. And then there's another one I know you talk a lot about as well, which is once you have that base of a good economy locally, you then have to look at the actual inventory of housing itself. And I know this is probably a question you get a lot. This is one of the most common things I get, particularly for people living in high cost areas, is they say, well, of course, there's great jobs here in the Bay Area of California, or great jobs here in Toronto, Canada, but then I can't find a, quote, good deal. And that leads to another conversation about what does it mean to have a good deal, even in a market that has a good economy. And so I know you've talked about in the past, like differentiating between these cash flow centric markets, you call them boring markets, versus a market that's more of a cyclical or an up and down high growth market, often on the east and west coast of the United States. Maybe could you talk a little bit about that, maybe with the backdrop of the good economy? Like what do you then look for to differentiate between those different types of markets?
Again, very big, broad question. That's a whole podcast episode in itself.
Of course. Well, and let's focus that in again on my person's decision. So this is this person who is just getting started. They got $50,000 perhaps, for example, and they're kind of stuck at this level of like, all right, well, I like real estate. I like owning direct real estate. That's what I think I want to do. Like, I live in Bay Area of California, where median price is $850,000. Should I do a house hack here? Should I go buy some other area? So I guess that's from the context of that person's decision point. How are they deciding between where they're trying to go?
It's a good question. I'll simplify it a little bit. So regardless of where you live, because, I've always been market and area agnostic, and my team here is market agnostic, and we believe investors should be market agnostic, because regardless of where you live, unless you live in a great market, well, it doesn't even have to be great. Unless you're in a good market that is conducive to real estate investing, it'll serve you well over time. You have to ask yourself this question: where should I invest my capital where it's going to generate the best returns for me in real estate? And when you ask yourself that question, you have to be open to the fact that we're in a country that has over 500 MSAs, metropolitan statistical areas. And because of that, there are a lot of opportunities, and the probability of there being a market out there better than the market you live in, like as in your backyard, is pretty high. So if your goal truly is to put that capital to work and find the best deals, you have to look in the markets that produce the best returns. So knowing that, you need to decide what you are looking for. Are you looking for markets that are going to give you greater appreciation potential, meaning that you are growth oriented, you want to build a portfolio that has strong appreciation potential, but not giving up on cash flow? You're still going to have cash flow, or maybe let's call it worst case scenario, you break even for the first few years. As that market matures, you can increase rents. That's one strategy. The other strategy is more of a cash flow strategy. It's you want to focus on higher cash on cash returns and or higher cash flows in dollar terms. If that's your strategy, you're going to be looking at different markets. So today, and over the last few years, a lot of the markets around the country have been migrating or shifting from cash flow markets, or what we call the boring and linear markets, to more cyclical markets, because their growth curves have started to swing up faster than historic norms. And so the appreciation has been stronger in many, if not most, of the markets around the country. So what used to be a cash flow market is now more of a hybrid market or a growth market. So you're getting the cash flow, you're getting a rate of return, but you're also getting growth. But if your strategy is cash flow or cash on cash return more so than growth, then what you're going to be looking at are predominantly tier 2 or second tier and tertiary markets. The tier 1 markets are the big markets, like, the Boston, LA, New York, San Francisco, like major metropolitan areas that have very high property values. The numbers don't work out very well. They are, relatively speaking, unaffordable. It's hard to find inventory, and when you find it, it's very expensive, and the rents are very low. So that rent to price ratio has a very wide gap. The secondary markets that have not seen this price growth as much as the other markets, and the tertiary markets, which are the smaller, often bedroom communities, or markets or smaller markets further out from the major metro areas, are where you're going to find the highest cash-on-cash returns and often the best cash flows. For example, some of the markets in Wisconsin or Pennsylvania, places that I'm investing in right now for the cash flow, the cash-on-cash return. So if that's your strategy, if it's cash-on-cash return and cash flow, those are the markets you would look at. And about a third of the 25 markets that we are in, our company here, are focused on those markets. The reason it's only a third is because so many of the other markets that we're in, the other 2/3 of the 25 markets we're in, have seen so much growth over the last few years that we're just classifying them as growth markets. So you, as an investor with that $50,000 or $100,000, whatever it is, have to, as part of your strategy, decide, what am I looking for right now? And what do I want to accomplish? Begin with the end in mind down the road. If you're young and you've got time and cash flow is not as important to you today as it will be down the road, focus on building a portfolio that is going to gain as much appreciation as possible in the short and medium term, because down the road you can tap into that equity and leverage up. You can accelerate your wealth creation. You can accelerate your portfolio growth, because you can repurpose that equity and turn it into down payments that add additional properties to your portfolio. If you're older, more conservative, and or you're focused on more cash flow because you just don't need the equity, maybe you're already, equity rich, that's fine. Focus on the alternative. So those are kind of two very general ways to deploy that capital, but it's not so much about how much you have as it is about what is your overall goal and strategy, your age, the time you're working with, that kind of stuff.
Yeah, I'm glad you went there with the strategy, because I think this is a pretty big debate in the real estate investing community. Because my guess is that people know what they want: freedom, they want flexibility, they want options in life. The next step they take is I need cash flow to do that, because I need to replace my salary. So you say, okay, freedom, cash flow. Okay, let me go get cash flow properties. And that's usually the next logical step in people's mind, is that, okay, well, I need to buy cash flow properties right now. You made a distinction, which I want to dig into a little bit more. You said if somebody has a little bit more of a time horizon, let's just call it 10 years, 15 years, if they have some time and some patience, you said it might be a better strategy to buy a property or 2 or 3 or 4 that could then have some greater growth and appreciation. And then later on, you could turn that into cash flow. So why is that strategy potentially, what are the benefits of doing that as opposed to using that same money and just buying a cash flow property today? Like how, especially for somebody who has a little bit more of a time horizon?
Well, the thing is for most people, investable capital is not infinite. So this is why a lot of investors move into doing syndications, is because they run out of their own money and now they have to go after OPM, other people's money, because they want to accelerate what they're doing in real estate. And the only way they could do it is using other people's money, because they don't have enough of their own and they don't know how to increase their income and their savings to buy more real estate sooner rather than later. So they're kind of in this quandary where they don't know, they either can't or they don't know what to do to increase their own income for savings to buy more real estate. So the way you can cheat that, if you will, is to buy as much property. Well, first of all, you should always be focused on increasing your income no matter what, because that gives you more options. But, regardless of how much income you have or how much you can save as quickly as you can to invest in real estate, if you're investing in real estate in growth markets where it has strong growth fundamentals and a high probability of gaining equity through appreciation mostly, but also amortization, then it gives you options years down the road to tap into that equity through usually what people do is they do a refinance, cash out refi, and they pull equity out. The other alternative is a HELOC, which is not as sexy and usable, or a 1031 exchange where you sell the property and use that equity as multiple down payments towards more property. But the goal is still the same. It's really, how do I use that equity that's been building up and it's trapped in the property? I call it dormant equity. How do you put that to work? Because your rate of return on that equity is zero. But if you've got one or more properties in areas that are appreciating well, and now you're, several years down the road, you're at a point where you've got enough equity that you can tap into, pull it out, and use that for more down payment capital for more property. You're fast tracking, you're accelerating the speed at which you're building your portfolio. And so, this is why you want time on your hands. It's always better to start as early as you can investing in real estate, because real estate truly is a get rich slow investment, not a get rich quick investment. So in the beginning, you just have to be creative. What are all the ways that I can increase my deployable capital, my chunks of cash? Whether it's 2 jobs or a business or side hustle or a partner or a spouse, or, how do I increase that? That's what you do in the beginning. But as time goes on, you've got this equity that you can tap into and deploy to further accelerate the speed at which you're building your portfolio. And it's kind of like that snowball effect. I like the analogy of using a snowball. It's boring and slow in the beginning, and sometimes maybe a little frustrating. It's certainly not exciting and sexy, but you know what? After you've got 5 properties and 5 years have passed or 10 years have passed, and you look back, if you purchased well, you pick your markets well, you'll be very impressed with what you can accomplish in a relatively short period of time. And for a lot of people, they don't really even need more than like 7 to 10 properties long term, because 7 to 10 properties, if you snowball the mortgages and pay them off one at a time and accelerate that, over the course of 10, 20 plus years, those 7 to 10 properties can be a pretty good nest egg and income generator.
Yeah, you can do a lot of things when you have 1,000 times 7 or 1,000 times 15. You're starting to look pretty good.
100%.
Yeah.
Yeah.
Yeah. And so, I appreciate you going into that, because I think the mechanism, and the reason I'm just harping on that so much, is that I feel like sometimes people get into the tactics, which are definitely important. Like I talk tactics all the time, but stepping back to this strategy of like, how are you actually going to put this thing together? It helps you to be patient when you know what's coming. That you have to be, if you go with a growth strategy, the idea is to turn that $50,000 into $500,000, and then you can redeploy it, as you said, either refinancing or selling it and trading it for another property. That's the path a lot of us are taking now with these growth markets. Like markets where I grew up in Atlanta used to be more of a cash flow centric market. I like how you've talked about how they've kind of grown into growth markets. What used to be California and New York is now Nashville and Dallas and Austin and all these other places. And then I want to go back to the cash flow model, because I have actually taken the approach, kind of both approaches within my portfolio. If you are a cash flow centric investor, there's also a growth component there too. It's just going to be, you're reinvesting that capital. It's like a business that has revenue from selling widgets. You're going to take that revenue, save that revenue, pile it up, buy another property, or save it up, and pay off a debt. And it's just it's also a slow burn. It takes a while to do that. There's some tax angle differences. You have to pay more taxes on cash flow than you would on appreciation. So it's an interesting game, but I think a lot of my listeners, Marco, they tend to gravitate towards one or the other, or maybe they're having a hard time getting their head around the growth strategy in particular, because I feel like it's almost like a different kind of physics or something. It's just a different mindset when you're just looking at cash flow, and then all of a sudden you're plopped into this weird market where you've got to make money with growth and cash flow, and people are just having a hard time getting their heads around what's the strategy here? Where am I going with all this?
Well, if that was a question, again, it all begins with, what is it you're trying to achieve? You start with your strategy, right? And that's built around your investment goals. So you're trying to, build a portfolio of property for your retirement. So you have that cash flow, and you build equity over time. If that's the case, then you got to start to break it down into more specific criteria, the types of markets, the types of neighborhoods, the types of cash flow or rates of return you're looking for, and that criteria becomes your buy box. And then your buy box is that checklist that you use to identify the properties that meet that criteria that you're going to invest in. So, I'm not exactly sure, what your question is, but it all starts with, understanding your goals, building a strategy and a plan around that, and knowing what your criteria is, and then just buying those properties as quickly as you can. There's something you said a minute ago that I just want to make a quick comment on it because it ties in with what we're talking about too. We've been kind of fortunate in a way to see the type of appreciation that we've seen over the last 2-3 years. And there's different reasons for that. One, we're in an inflationary environment. Two is, the quantitative easing and the loose money in the system. Thirdly is the strong imbalance between supply and demand right now. I mean, we're looking at months of inventory right now in most markets that average 0.8 months of supply. Very, very low. When, it used to be considered that a normal market was between 4 and 6, maybe 4 and 5 months worth of inventory in a market to be balanced. I mean, we don't see that anywhere. Even in some of the more expensive markets, like the tier 1 markets, like San Francisco and whatnot, like we've got less than 1 month's worth of supply. And in many markets, properties will hit the market within 24 hours. There are offers on that property, some of which are all cash offers. That is just crazy. But the point I'm trying to make is this: don't speculate. Don't invest, with a gambler's mindset, because appreciation will happen. Equity will grow. Even in some of the less attractive, not so good markets to be investing in, you're still going to experience that in the short term and certainly over time. But don't let that be the driver. Don't be a gambler in real estate. Don't be emotional. Be objective. Use your head. Common sense, build the right team around you. Make sure you have the right team to guide you and provide you the right opportunities and the financing and advice and all that good stuff. But if you do that, you will be very, very successful. And so, I mean, that's kind of not a non-answer to your question, but
yeah, no, I sort of threw a statement out there to you, and that was perfect. I
turned it into a question.
Yeah, you did well, and we're kind of coming up on time, but I wanted to get more into, and we'll have to save this for another call, into the business model of buying properties as a busy investor that are more turnkey or that are already kind of ready to rent, as opposed to being the DIY investor, which is a lot of what I actually have done in my own past. Mm-hmm. But I want to give you a chance just to hand off some of what your business does at Norada Investments, and kind of just that for people who are interested, they can dig into your website, they can listen to your podcast, which I'll put links to in the show notes as well. But just to tell people, if they are interested in that kind of long-term choosing the right markets perspective that we've talked about a lot today, like what sort of the highlights of what your business does and how that might be able to help them out with that.
Yeah, I'll touch on that real quick. And then to wrap things up, I do want to make a comment that I think will be a nice bow to wrap up this conversation.
Right.
Our company is very straightforward. We provide a service where we have everything for an investor that is looking to be involved, but not necessarily do everything by themselves. It's built on, what I started on in 2003, investing 3,000 miles away. I was a long distance investor, and, I built up a great portfolio, and I became very successful at it. But we provide, knowledge, education, resources, and property. So investors would come to us. We'll assign them an investment counselor. There's no cost. Everything we provide is at no charge. And we have properties in 25 different markets, like a lot of property. Most of it's now new construction, but some of it's refurbished. But we've got the properties, the property management, the financing, asset protection attorneys if you need it, tax advisors if you need it, property inspectors, anything and everything someone would need. So we provide a lot of free counseling. It's, we don't call ourselves advisors, but, we have investment counselors that basically hold you by the hand and help you define those goals and that strategy that you need, and identify the markets that make sense, and choose properties that we could show you based on your investment criteria. Most of these are exclusive and off market. The very little of it is MLS based because we just have relationships all around the country. So Does that answer your question?
Yeah, that's great. Yeah, there's a lot of options out there, and I think this will be a good follow-up conversation as well. There's different ways people can invest in real estate. You can build your own team. You can, a lot of what I teach is, hey, go out and figure out how to build that team and call that person and find that mortgage broker, find that that deals yourself. But the reality is there's a lot of people out there who have less than 5 hours a week and they're interested in real estate and they need to be able to do this. And so it's a very interesting service. And I think I would recommend people check it out. And I think the thing that sets you apart, what I've seen, Marco, and just what to recommend to people is that market analysis and also the track record. There's lots of offerings out there in the market, but understanding the market fundamentals has always been one of the most important things for me as well. And so that it's a moving target. Things are going to 5 years from now, things might be different, will be different than they are right now. So I appreciate what you do in terms of just providing knowledge. And I was even looking today on the website, just you can look at each of your market areas. Like I'm familiar with Charlotte, being in the Carolinas, and looking at long-term trends and appreciation rates and price-to-income ratios. A lot of just really good data for anybody just to check out to understand that market better. So thanks for the service you're providing for that as well.
Yeah, and it's all free. It's all posted on our blog. There's tons of articles. We do two market spotlights a week right now. So yeah, it's all there for everybody to see. Free stuff.
Okay. Great. Well, thank you for that. And you said you had one final, I have one final question that I will throw out to you to kind of wrap it up. So this is a show about financial independence and we've talked a lot about building wealth and turning a small amount of money into a large amount of money. But I want to go back to that person who's in the trenches right now. And they're like, okay, this is interesting. I want to do this, but I'm just got life happening. I'm busy and I'm trying to see that 10 years from now, 15 years from now, this thing's possible. Do you have any final tips for them, or just to help them have a little bit of hope, a little bit of forward progress that this is something they can do?
Yeah, to answer that question, and I say this often, look, you could educate yourself to death. You could spend all the time listening to your podcast, my podcast, reading articles and reading books like your book and whatnot. And you can become the most educated non-investor out there. At the end of the day, ask questions and take action. Start talking to people, build yourself a team. It doesn't matter who it is. It could be you as a coach, it could be us as a turnkey provider. And just start asking questions and building a team. But the bottom line is you have to take action. You can educate yourself to death, but until you actually pull the trigger, you're not going to make that next step and next step and next step to get you to your goal. You're going to stay where you are. So as simple as it sounds, you've got to take action.
Yeah, that's where the education begins, right? You got it. That's
totally
the school of hard knocks. So
education is the first step. Action would be the next step. Yeah.
There we go. Great. Well, thank you, Marco, for your time. Really appreciate it. This has been a lot of fun. I've enjoyed the conversation, and I look forward to following up with you again.
Sounds good, Chad. It's been a pleasure. Thank you.
Yeah, enjoyed it. If you like the show, I'd like to invite you to subscribe to my free email newsletter at coachcarson.com/REI toolkit. In addition to weekly updates, articles, and behind-the-scenes tips from me, my email newsletter subscribers get my real estate investing toolkit, which includes a property closing checklist that I actually use when I buy properties, a real estate deal worksheet, a tenant screening criteria checklist, and other spreadsheets and goodies that will help you on your journey to financial independence using real estate. You can get it all for free at coachcarson.com/REI toolkit. I also want to take this time to thank some people behind the scenes who make this podcast possible each and every week. This includes my podcast editor extraordinaire, Michael Wynn, my amazing virtual assistant, Megan Thompson, my wife, Carrie, who helps me behind the scenes and is my partner here at Coach Carson. And of course, thank you to all of you, the listeners of this show who make everything possible. This show exists for you. It exists because of you. And I really appreciate you being here for another episode. Everything I've shared with you in this episode has been for general education purposes. I've not considered your specific situation or risks. Before buying your own investments, be sure to consult a financial, real estate, and/or a legal professional. Until next time, I'm Chad Carson. You can also call me Coach, and this is a show all about helping you get out of the financial grind so you can do more of what matters. See you next time.